Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Thursday, June 25th, 2020. And today's top stories, we'll take a look back at what occurred economically and in the markets these past 3 months, and why markets trend toward the extremes. And joining me now is Dr. David Kelly. He's the Chief Global Strategist for JP Morgan. Dr. Kelly, thanks so much for joining us on the program this morning.
Glad to be here.
It's great to talk with you. So we talked almost 3 months ago, we were chatting about the economy. I think we were just at the beginning of the pandemic. And I wonder if you might maybe reflect back on what has transpired over the last 90 days. Certainly it's been a lot in markets, it's been a lot in the global economy and in the US economy.
Yeah, there have obviously been some shocks in all of this. I have to say that once we had an idea of what this virus was, and we sort of got that idea towards the end of February, I think that much of what has befallen us since then was somewhat predictable. I mean, you could see what this was going to do to the economy, to a lot of the industries that involve social mingling. So you could see that big recession coming. We certainly got a big fiscal response, a big monetary response. Nobody can say Washington has been sitting on its hands here. And I think, if looking back on it, one of the surprises is that the stock market, not so much that it fell, but that it rebounded so strongly from its March lows. There's a lot of uncertainty out there, and there does seem to me to be a little bit of complacency among investors, given how much uncertainty remains in the environment.
Yeah, I agree that there is a lot of uncertainty. Parts of the United States have begun to reopen. I'm in New York, but other places around the country, Texas, Florida, South Carolina, elsewhere, begun to reopen. They're in various phases. But we have seen a spike in some cases. Do you, just based on the data that you're seeing, think that, how will this, let me ask you this, how will this impact future economic growth and even the markets?
Well, first of all, on the virus itself, I think every discussion has to start with the virus. And the truth is, the virus, I suppose it does mutate over time, but it hasn't basically changed. What this is something that is highly infectious. And if we go back to normal behavior, it would, left to its own devices, infect more than half of America within 3 months. That's what it would do. And social distancing has been effective where it's been employed in squashing the virus. But whenever you relax, it's going to get going again. And so what's happened is, I know I live in Massachusetts and up in the Northeast as well, in New York, New Jersey, Connecticut. Governments and the people have been very successful in squashing this virus because there was a horrible outbreak. But in other parts of the country where they haven't been through as much trauma, they have started relaxing more broadly, and the virus just coming roaring back. And that's what it's going to do. And we can't just let it run rampant, because there's still only a very small fraction of the American population who's had the virus or has any immunity to it. So I think we're going to be battling this thing all the way until we have a vaccine, hopefully by the second quarter of next year. But for as long as we're dealing with this pandemic, it's going to suppress economic growth. So now, getting to your question, we shut down an awful lot of things. And then in trying to reopen, we've sort of figured out, well, what businesses could operate in this environment? I mean, you can buy a house, you can sell a car, you can manufacture most things with appropriate social distancing protocols. And the industries that could reopen are reopening. And so that's what's giving you a bounce in economic activity, which you will see in the third quarter data. But I really want to emphasize, this is not a V-shape. Because the problem is that there are a whole pile of industries which just can't operate while you're trying to suppress a virus. You can't pack movie theaters or ball games or airplanes or hotels or restaurants or retail malls. You just can't do it and keep the virus under control. And I'm afraid those industries will remain suppressed throughout this.
Dr. Kelly, I think one of the concerns still remains small businesses. And I think you alluded to this in what we were talking about in your previous answer. We have restaurants, we have small businesses, small technology companies, each of whom are struggling. Maybe some have dealt with social distancing and worked remotely, to your earlier point. But even so, a restaurant may not be able to fill to 100% capacity. They may have to only be able to fill to 50 or 60% capacity. Is there any concern in terms of a recovery, in terms of the impact to these small businesses and what that could mean to the U.S. economy longer term?
Yeah, I think there is, because I think there's, frankly, the policies coming out of Washington aren't really aimed in exactly the right direction. What we have to do is recognize that a lot of these industries simply can't work in a social distancing environment, but will work fine once there's a vaccine to the virus. So what we need to do is sustain these businesses and sustain the equity that these small business owners have in their businesses. After all, it's their blood, sweat, and tears that have gone into these businesses over the years, and they should be protected from this. I think actually the Europeans may have done this better than the US, because what they're doing in Europe is they're paying basically workers to stay at home, but still remain employees of these businesses, and that's helping the businesses sustain their equity capital in these businesses, and that's really what I think is important here. So I am worried. I mean, ultimately the economy is going to bounce back. Somebody will be running these businesses, but it is a great tragedy that if you put 20 or 30 years into building up a restaurant, you go bankrupt, somebody buys up the property, takes up the lease, and they're running a new restaurant, and you just got wiped out because of this pandemic, and that's a shame, and that should not be allowed to happen. And also, there's no point in I believe that we have to give people an incentive to work when they can, but you should not try to put people in a situation of desperation where they have to work in industries that are patently dangerous in order to prevent starvation, because that will only make the virus worse. Those are the actions of a third world country or an economy without any real central government. We should be better than that.
Yeah, or a banana republic, as I would call it. Last question for the segment. There's obviously a lot going on. We were hit by COVID. Then we had a lot of unrest in the country. We still do have a lot of unrest. And we have an election coming up. How does this impact all these different factors? I mean, I know, it causes disruption in terms of the unrest, and rightfully so. There's a lot of concern there. But also the election. How does that all get baked into Q3, Q4? What could we possibly expect going forward?
Well, I think that let's take these things separately. The pandemic, we're pretty clear on what it's doing to the economy. The unrest there are multiple dimensions to this, of course. There are millions and millions of peaceful protesters who've just had enough, and that's why they're protesting. And that's their First Amendment right. But there was, particularly in the early days of these protests, a lot of property damage done also by looting and rioting and so forth. Mm-hmm. When you look at this from an economic perspective, it's actually rather like the effects of a hurricane. So a hurricane can blow into, say, Miami and destroy a lot of property, and there are a lot of great property that's destroyed. But all you can do the next day is try to rebuild. And in terms of the GDP effect, it's essentially called depreciation. But then you put more construction activity into getting going again. And essentially, it happened at a very bad time in the middle of a pandemic, but I don't think that has a lasting effect on the economy. And then on the election, there's a lot of uncertainty around this election, and I do think that economic policies after the election are very important for where we go in the long run. I think the choices will be starkly different. But between now and the election, I don't think that uncertainty will have a particular impact on the economy.
It's certainly going to be interesting to watch. Dr. Kelly, I want to go to a quick break, but when we come back, we're going to talk about how and why markets trend to go to the extreme. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy.
featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're joined this morning by JP Morgan Chief Global Strategist, Dr. David Kelly. Dr. Kelly, thanks so much for sticking around with us this morning.
Happy to.
So really interesting snapshot, if you can call it that, into the economy. But one thing that often comes up is the volatility and the extremes that we seem to be going through when it comes to the markets. And it's not just with COVID. We've seen it play out over the last few years, maybe beyond that. And I know you just wrote a very interesting article that I read on LinkedIn about how markets may trend to the extreme. What can you tell us about this? Is this going to be more of the same, up and down, I'm going to be like a yo-yo?
Well, I think the volatilities and the trends are the volatility and the trends are 2 different things. What I think I'm really interested in, and what I get asked a lot about, is there are a lot of people who are fundamental analysts out there, and a fundamental analyst basically tries to figure out what the fair value of an asset is. And they know that for various reasons, shocks and so forth, or psychology, the markets will trend away from that for a while. But the idea is there's some natural gravitational force that'll pull you back to fair value. But if you actually look at the trend in markets in recent years, there are these extreme trends. And we've seen a 40-year decline in long-term interest rates. And if you and it just keeps going and going and going, so that now you can buy a 10-year TIP, a 10-year Treasury inflation protected security, which guarantees you that if you hold it to maturity, you will earn a return of negative 0.6% in real terms. In other words, the reward for you saving today is that you are guaranteed to consume less with it when you get your money back in 10 years' time. That's an extraordinary thing. You've got Bitcoin, which frankly has an intrinsic value of $0, which is trading at $10,000 and has been, and hit $10,000 over 2 years ago. How can it stay in suspended animation? You've got this enormous gap between value stocks and growth stocks, which just keeps on growing. Even though, again, based on the fundamentals, a lot of the growth stocks look a little expensive and the value stocks look cheap. And finally, another thing that I'm very interested in is US stocks continue to do well on a rising dollar. International stocks lag behind. Again, based on the fundamentals, the gap in valuation should not be that big. So I think this really interesting phenomenon of these trends which just go on and get stretched and stretched beyond what seems reasonable based on the fundamentals. And
this can have a negative impact. I mean, you mentioned the TIPS, which has a negative rate, and that seems to make sense. But this can have an impact on investors out there, whether you are a pension fund, an endowment, so you're an institutional investor, and you're trying to reallocate or allocate for the future because you're trying to think about your assets versus your liabilities and when you're going to need the money, or for someone who's saving and planning and allocating for their personal financial future. They're thinking about retirement within their DC plan, right? I mean, there's a lot of implications here longer term about these extremes.
Yeah, I think there are different implications. I mean, one of them if you are moving into retirement right now. And what's happened in many cases is you discover that you've got a bigger pile of money than you ever thought you'd have. And that's really good because you've been the beneficiary of these rising markets for years and years and years. The problem is that you want to live off the income that will be produced by this pile of assets. And when you look at the yields on bonds or the coupon or the dividend yields on stocks, they seem miserably low. And so you've got to adjust your strategy. And I think one of the adjustments is we've got to get over this idea of never selling principal. I think in many cases it is actually more dangerous to stretch out in the yield curve for long duration bonds, or to buy the most risky bonds or stocks just to get high dividend deals or high coupons. It's riskier to do that than to sell a little principal because after all you have more money than you thought you would have. Therefore you can actually throw a little bit of principal into the pot every month or quarter as you draw an income in order to get that income. I think so you have to adjust strategy for a world that is very much out of whack. So I think that's one of the implications. And then of course the other implication, the other question I get asked all the time is, why do these trends go to extremes and what's going to cause them to turn? When you think about what's driving them to extremes, I really think a lot of it has to do with a very long-term trend of actually rising financial assets and a rising flow of money going into financial assets. This has been going on so long that we almost think it's the natural state of affairs. But if you think about it, ever since the early 1980s, first of all, you had the baby boom moving into their peak earning years, and they were putting money into financial assets, and that helped. Then you had a great increase in inequality, and with more money going into the hands of richer Americans, they tend to save more. And then you had things like the 2017 tax bill, which also seemed to benefit richer individuals, and that all of this is pouring money, year after year, a flow of money into financial assets, pushing assets up. If you think that asset prices always go up, you get a little lazy on the fundamentals. You think, well, let's just jump on the fastest moving train here, and that helps momentum. It helps these trends move further. But if you have a reversal, if you have a period of time for a few years or maybe longer in which money is actually coming out of financial assets and assets are losing value, then suddenly you focus a lot on, well, how much is a stock actually worth? Or what is a Bitcoin now that I'm thinking about it? And as you have to ask these fundamental questions, that I think will tend to bring down the high flyers much more than the things that are more based in fundamentals. So I do think eventually fundamentals will win out again. But I think we may need to see that correction with money genuinely falling out of financial assets or coming out of financial assets for a number of years. And there are lots of things that could cause that. Less inequality, the baby boom retiring, higher taxes, all of this could pull money out of financial assets. But when it does that, then I think the fundamentals become more important. And in the meantime, as an investor, when I talk about diversification, make sure diversification includes buying the stuff that is genuinely cheap. Because in those days, if you have a negative market overall, you really want to be invested in those things which will hold up best in that kind of environment.
Yeah, absolutely fascinating. Dr. Kelly, it's always a pleasure chatting with you. I walk away and I learn like 20 things. I'm hoping I'm able to retain it by the time I get to the next show. Great seeing you. Always a pleasure chatting. We look forward to having you back on the show very soon.
I'd be very happy to do that. Thank you.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, and more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Attention! The Centers for Medicare and Medicaid Services has officially authorized new benefits that Medicare Advantage plans may include. To get the benefits you deserve, you can call the Medicare Coverage Helpline.
Hi, I'm Joe Namath. If you're on Medicare, this is important information. I called the Medicare Coverage Helpline and they instantly looked up my coverage. In this one simple call, they offered to enroll me in a plan that includes rides to medical appointments, private home aides, doctors and nurses' visits by telephone, and even home-delivered meals. The plan also includes dental, vision, hearing, and prescription drug coverage, all at no additional cost.
Don't delay. Call to see if the new benefits are available in your area.
Call the number on your screen now. It's free.
Call 1-800-757-1451. That's 1-800-757-1451.